So I would like to say I'm going to keep this short and sweet, but if you know anything about me, you know I like the sound of my own voice, so I may ramble on for a little while here. If that's the case, I'm going to apologize in advance. However, I figured it was time for an update. We had the latest update from the Bank of Canada came through this morning. We were all sort of expecting a 0.75% increase today, and that hasn't happened. They've decided to go up 1 whole percent today. So, I mean, that's probably going to sound a lot scarier than it is in real life. 1% sounds like a really big number. Bank of Canada hasn't done this since the late 90s. So it's been an awfully long time since they've done an increase quite this big. However, that's really only a 0.25% difference over what we were expecting. And looking forward to the next, 6 months or so, we are expecting some more rate hikes still this year anyway. So I think, a big part of what's happening right now is that they're trying to front load these interest rates, trying to do a little more aggressive increases right now, so that, we have a little less increase or a little less need for increase later in the year. And one of the interesting things I read this week actually is there was a study done that they did a survey. Survey said around 40% of Canadians didn't feel confident that the Bank of Canada was going to be able to fix or rein in inflation. Um, I have a sneaky suspicion part of this move today is a little, nod, a little jab at those 40% of people who thought they weren't going to do anything about this or that this wasn't going to help. I also think Bank of Canada are making decisions based on past information, not current or future data. So a lot of the increase or a lot of the impact of these last couple of increases we've had hasn't really been felt yet, especially in the mortgage world for a lot of regular everyday people. If you have a variable rate mortgage, that last increase that happened hasn't even impacted your payments yet. So for a lot of us, we haven't actually felt the impact at a personal level of these rate changes. What that tells me is that, we're going to see a bigger impact on the economy in the coming months than we're actually seeing right now. You kind of tie those two things together, and that'll sort of lead into what I want to talk about later. But coming back around to what's going on this week. So personally, we've had a weird week. Things always tend to happen in threes, and I've had two computers kick it out on us this week unexpectedly. Brittany's gave up on us on Friday, which meant scrambling to figure out a solution to get her all set up. And then we came in Monday morning to my computer having given up as well. Obviously, that meant a little bit of scrambling now on my end, trying to get myself set back up here at the office. So that's our two, and then a rate hike this week that's more than we were expecting gives me my personal three things this week. I'm hoping that's it and we won't have any more surprises. So bad news in all this. We know the rate's going up. Really, bottom line is this is just a slightly bigger increase than we were expecting. That's it. That's all the bad news. For most of you who have been following me for the last few months, you guys know that this is part of the plan. We've sort of built this into our expectations of where rates are headed this year. And don't forget, this rate change only impacts variable rate clients. So if you picked a fixed rate a few years back, or if you're in the process of deciding what you want to do now and you're thinking of choosing a fixed rate, nothing changes. Don't panic. This is not you if you are a fixed rate. This is something for people in variables to consider. The good news in all of this, one of the big sort of silver linings that comes out of a bigger increase than we were expecting is the overnight rate. The rate that the Bank of Canada is adjusting when they do this is now at 2.5%. So their neutral range, they call it, where they want that rate to be, should be between 2 and 3% if everything's working the way it's supposed to economically. Right now, obviously, it's not. Inflation is much higher than we want it to be. So Bank of Canada is trying to get that overnight rate up to the top end of that range, possibly even a little higher. The goal from everybody's perspective at this point is to probably get that rate up to 3 or maybe 3.25. I think that's reasonable. So that's 0.75 higher than where we're going to be at as of today. So what this means is we're just getting closer to that peak a little sooner than we thought. I personally don't think that's a bad thing. It's going to give the consumers, going to give everybody at a national level the idea that Bank of Canada is being proactive, that they're doing something about the economy, and hopefully it'll inspire that confidence in the general public that they need in order to get inflation under control. One of the problems when things cost more is people expect things to cost more. When that happens, it becomes a self-fulfilling prophecy. We all expect gas is $2 a liter now, so gas is $2 a liter. And the two go hand in hand. What Bank of Canada is trying to do is convince you that this problem can be solved and that things will not always continue to get way more expensive as quickly as they have in the last year of our lives. One of the other things I thought was important to mention, especially for those of you who do have a variable rate mortgage, most of you have an interest rate somewhere between 3.5% to 4% after today. So 3.5%, 4%, historically speaking, pretty normal. In fact, it's on the lower range or the lower end of what normal interest rates should be. So it's not a bad deal. It's going to be more than you're used to paying, but it's still right in line with what should be happening normally with mortgage rates. And importantly, that is still way lower than fixed rates. Fixed rates right now for a typical 5-year term are going to be 5 point something. A lot of them we're seeing right now are 5.3 or even 5.4%. So you're still 1.5%, maybe even 2% lower than what fixed rates are. That sort of helps answer the question of, do we lock into a fixed rate right now? Probably not, unless something has changed and it really makes sense to opt for that, 5 or that 5.5% interest rate. Most of us are going to just absorb the impact of that payment change or that adjustment to our payment amounts this month. And we're going to thank our lucky stars that we're in a variable because we're still lower than today's fixed rates. I still think it's the way to go. Long term, one of the reasons that we pick fixed rate or pick variable rates in the first place is for those of us who are comfortable with riding out fluctuations in the economy. So no different than investing in the stock market. We were talking about this morning. So when stocks are on sale, like what's happening right now in the markets, don't bail out. Now is not the time. Hold on. In fact, now is a good time to be buying investments. We've seen this big dip in the market. Variable rates with our mortgages, we're going through the same process right now. We're going to go up. We're going to hit this peak. An awful lot of people are going to want to bail. And if they do, they're going to jump into these 5+% fixed rates. However, all of the rate increases we're seeing this year, when inflation finally gets back to normal, when supply chain issues start getting resolved, these big mega ports in China start shipping goods again normally like they should be in the coming year, when things in Ukraine eventually reach some sort of settlement, some sort of ceasefire agreement, the cost of goods is going to go down. Combined cost of goods hopefully coming down with interest rates already being inflated, that's a bad combo. That's going to likely lead to a recession. If recession happens, what do we do to convince people to spend more money? Lower interest rates. The Bank of Canada brings rates down again. So I think what we may very well see is that rates reach this peak. We're going to hit that peak sometime towards the end of this year. And that if we hit that recession that I personally am anticipating, rates are going to come back down again. They're at least going to stall. And I honestly expect that Bank of Canada is building in some buffer to lower rates later. So long story short, if you're comfortable with where your payments are at, if you're okay riding that wave up just a little bit more, I'm suggesting you hold on because I think a lot of this is going to end in some big slowdown economically, and that is going to lead to interest rates settling back down again towards the end of next year. If you can afford to hold tight and ride that out, I think there's going to be some benefit there in the long run. And the last thing I'll leave everybody with is for all of you worried about, big scale, are we going to see people handing in the keys and walking away from their homes or see some sort of big collapse in the housing market? I really don't think so. The honest truth is anybody that picked a variable rate or a short-term mortgage anytime in the last 10 years of our lives have all been stress tested in some way, shape, or form. So this stress test essentially means that even if your contract rate was 2% back when you took your mortgage out, your bank, your broker, whoever it was that did your financing, qualified you at least 5.25%. So that 5.25, most of the people in variable rates, we're not there yet. We're at 3.5, maybe 4%. So we know from a large scale standpoint, even these people that are riding variable rates up, they're still within the realm of what that stress test or that qualifying rate would have been, which means they should be able to continue making those payments. It's going to hurt a little bit. I'm not trying to say that another $150 or $200 a month on your mortgage is a good thing. It's not. That hurts all of us. It eats into our spending power and convinces us to not spend money elsewhere. That's what Bank of Canada wants. That's why they're doing this. But in the grand scheme of things, this is something that most families are going to be able to make accommodations for. They're going to be able to adjust their budgets. And historically speaking, as Canadians, we don't give up on our housing. We don't throw the keys back at the bank when it comes time for things to get tough. These are tough times. And I think what most of us are going to do is we're going to buckle down. We're going to keep making our payments. If you are in, that category where you are really having a hard time, you're worried about your payment amounts, or you're worried about things going up any further from here, call me. I'm always happy to take some time to take a look at things. One of the things I expect we're going to see in the next 2 to 3 years might be a lot of people choosing to refinance right now, thinking about extending that mortgage out, maybe worrying less about the actual rate, but focusing more on what your payments are. If you've been working really hard paying your 2% mortgage off, hoping for a 15-year payoff, maybe 15 years isn't the goal anymore with rates where they are today. Maybe that goal is 20 or 25 years. You stretch that timeline out, brings your payments down, and it makes it a little bit more manageable. There are ways to adjust for this. So even as rates go up, your payment doesn't necessarily have to. If you're worried about that, call me, shoot me a message. I'm always happy to make some time to take a look at it with you. And I think it's something that we're going to see a lot more of going forward. So don't be shy. In the meantime, as I always say, if anybody has questions or you guys want to have a chat, send me a message, give me a phone call. You guys know where to find me. And hopefully, everything will be okay for everybody out there. We're going to ride out this slightly bigger than planned rate increase. And I'm hoping that a little further in the future, those of us who are still holding on to our variable rates are going to see that pay off. But you got to stick it out. Thanks very much. Have a great day, everybody.